Here's a comprehensive summary of the revolution that wasn't: GameStop, Reddit, and the Fleecing of Small Investors by Spencer Jakab. Introduction. The Revolution That Wasn't by Spencer Jakab delves into the GameStop saga of early 2021, examining the forces that drove the unprecedented rise in the stock's price, the role of social media, and the broader implications for retail investors. Jakab provides a nuanced look at how a seemingly populist uprising against Wall Street ended up reinforcing many of the existing inequities in the financial system. Background and context. In January 2021, GameStop, a struggling video game retailer, became the epicenter of a stock market frenzy. A group of retail investors, primarily congregating on the subreddit r/WallStreetBets, began buying shares en masse, driving up the price from around $20 to an astonishing peak of $483. This movement was framed as a David versus Goliath battle, with small investors taking on powerful hedge funds that had bet against GameStop. The players. 1. Retail investors, the small-time investors, many of whom were motivated by a mix of financial ambition, boredom during the COVID-19 lockdowns, and a desire to stick it to Wall Street. 2. r/WallStreetBets, the subreddit where much of the coordination and discussion took place. Known for its irreverent and often reckless approach to investing, it became the hub of the GameStop movement. 3. Hedge funds. Several hedge funds had significant short positions in GameStop, betting that its stock price would fall. The most notable among them was Melvin Capital, which suffered substantial losses as the stock price soared. 4. Robinhood, the commission-free trading app favored by many retail investors. Robinhood's decision to restrict trading in GameStop and other volatile stocks at the height of the frenzy led to accusations of market manipulation and favoritism towards institutional investors. The build-up. GameStop was a company facing declining sales and a bleak future in a digital world. Hedge funds identified it as a prime shorting candidate. Shorting involves borrowing shares to sell them with the hope of buying them back at a lower price, pocketing the difference. However, shorting carries the risk of unlimited losses if the stock price rises. The community on r/WallStreetBets noticed the high short interest in GameStop, meaning a large percentage of the stock was sold short. They realized that if they collectively bought and held the stock, they could create a short squeeze. In a short squeeze, rising prices force short sellers to buy back shares to cover their positions, driving the price even higher. The frenzy. As more retail investors bought into GameStop, the stock price began to climb rapidly. The story caught the attention of mainstream media, further fueling the buying frenzy. The narrative of small investors beating Wall Street titans resonated with the public, especially given the backdrop of economic inequality exacerbated by the pandemic. Celebrities and influencers joined in, amplifying the movement. Elon Musk's tweet "a GameStonk" added to the hype, sending the stock price soaring even higher. For a brief period, it seemed like the retail investors had turned the tables on Wall Street. The crash. However, the euphoria was short-lived. On January 28, 2021, Robinhood and other brokers restricted buying of GameStop and several other stocks experiencing similar volatility. This decision caused an immediate drop in GameStop stock price, leading to outrage and accusations of protecting hedge funds at the expense of retail investors. Robinhood explained that the restrictions were due to increased capital requirements from clearinghouses. Clearinghouses act as intermediaries in stock transactions, ensuring that trades are settled and completed. The unprecedented volume of trades had strained the system, necessitating the restrictions. Aftermath and analysis. Jakab argues that the GameStop saga was not the revolution it appeared to be. While a few retail investors made substantial profits, many more lost significant amounts of money when the stock price eventually crashed. Hedge funds like Melvin Capital did incur losses, but other institutional players profited from the volatility. Structural inequities. The episode highlighted systemic issues within the financial markets. The ability of retail investors to move markets through social media coordination was both a demonstration of collective power and a sign of the fragility of the market infrastructure. However, the quick reversion to the status quo suggested that the financial system remains heavily tilted in favor of large institutional players. The role of Robin Hood. Robin Hood's role in the saga is particularly scrutinized. The app democratized trading by eliminating commissions and lowering barriers to entry. However, its business model, which relies on payment for order flow (PFOF), where market makers pay Robin Hood for the right to execute its trades, raises questions about conflicts of interest. Critics argue that this model incentivizes Robin Hood to prioritize volume over the financial well-being of its users. Regulation and reform. The GameStop saga prompted calls for regulatory reforms. Some suggested more stringent oversight of short selling, while others advocated for reforms to the way trades are cleared and settled. Jakab explores these debates, noting that any changes will need to balance the desire to protect retail investors with the need to maintain market efficiency and liquidity. Broader implications. Jakab posits that the GameStop episode reflects broader societal frustrations with economic inequality and the perception that financial markets are rigged. The allure of r/WallStreetBets was not just about making money, but about participating in a movement that promised to disrupt the status quo. Lessons learned. 1. Market mechanics. The saga underscored the importance of understanding market mechanics, including the risks associated with short selling and the role of clearinghouses. 2. Investor behavior. Retail investors' behavior, driven by social media and a desire for quick profits, can lead to extreme volatility and significant financial losses. 3. Regulatory gaps. The need for updated regulations to address the challenges posed by new trading technologies and platforms became evident. 4. Economic discontent. The episode highlighted the deep-seated economic discontent among many Americans, which can manifest in unpredictable ways in the financial markets. Conclusion. The Revolution That Wasn't is a compelling examination of the GameStop saga, providing a detailed analysis of the events and their implications. Jakab's work serves as a cautionary tale about the dangers of speculative trading and the enduring power of established financial institutions. While the narrative of small investors taking on Wall Street is appealing, the reality is more complex and ultimately reinforces the need for greater financial literacy and systemic reform. Key themes and takeaways. 1. Power of social media. The role of platforms like Reddit in coordinating investor behavior and influencing stock prices is unprecedented, showcasing the power and risks of collective action in the digital age. 2. Fragility of financial systems. The rapid rise and fall of GameStop's stock price revealed vulnerabilities in the financial system, particularly regarding the infrastructure of trade settlement and the mechanisms of market regulation. 3. Economic inequality. The populist narrative driving the GameStop frenzy reflects broader societal frustrations with economic disparity and the perception that financial markets favor the wealthy and well-connected. 4. Importance of financial literacy. The GameStop saga underscores the need for better financial education. Many retail investors were unaware of the risks they were taking, leading to significant losses. 5. Regulatory challenges. The episode has sparked discussions about the need for regulatory reforms to address the evolving landscape of trading technologies and practices, including the impact of payment for order flow and the transparency of short selling. 6. Reality of market dynamics. Despite the appearance of a grassroots victory, the structural advantages of institutional investors and the inherent risks of speculative trading mean that the financial system remains largely unchanged. 7. Ethical considerations. The ethical implications of platforms like Robinhood and the responsibilities of brokers to their clients are central to the debate over market fairness and investor protection. 8. Psychological factors. The role of psychology, including the influence of groupthink, fear of missing out, FOMO, and the thrill of gambling, played a significant role in driving investor behavior during the GameStop saga. 9. Systemic reform. For meaningful change, systemic reforms that address the root causes of financial inequities and improve market transparency and fairness are essential. 10. Investor protections. Strengthening protections for retail investors and ensuring that trading platforms operate in the best interests of their users are critical steps towards a more equitable financial system. Final thoughts. The Revolution That Wasn't by Spencer Jakab provides a thorough and insightful analysis of the GameStop phenomenon, offering valuable lessons for investors, regulators, and policymakers. By understanding the complexities and dynamics of this unprecedented event, readers can better navigate the financial markets and advocate for a more fair and transparent system.